What we've been talking about today is the issue of risk management. And the point I was starting from is that life is a risk, that all of us are exposed to risk all of the time. And survival is about effectively managing that risk. And I think what's important in the context of this particular presentation is that it's the poorest that are most exposed to risks, and it is the poorest that have the least resilience to manage those risks. So what I was doing in this presentation was looking at a very broad range of different instruments that can be used for risk management. And I started from those which are really very individual and then moved through a spectrum to those which are really quite universal. And that encompasses a number of different providers and a number of different beneficiaries at different levels. So the 12 instruments that I looked at in some detail are on a range from having very large families, which is the most traditional approach to risk management, buying and selling assets, building up assets in good times, selling them in bad times. Community reciprocity, building up social networks where you give to those who are less well off than you at times when things are good, and you receive back when things are not so good for you. Then to the slightly more formal structures like savings and loans, micro savings within communities and at that level. Then another common way of managing risk at household level is through diversifying your risks, through having different sources of income, different agricultural products that you're producing, so that if one fails, you have others to fall back on. Then, again, getting more formal, microcredit and banking arrangements, so that you can borrow when you need and pay back when you have the resources to do so. Formal insurance markets, which do provide actual insurance against specific events. Warehouse receipts systems, which allow you to acquire credit against production that you have yourself produced. Weather insurance systems that provide insurance to whole groups of farmers. The use of futures and options on commodity exchanges to spread risk. Strategic grain reserves used by governments to dampen price rises and to release food onto the markets when it's in short supply. The whole question of subsidies, either of inputs or of consumables. And finally, the area of social transfers, where government is deliberately providing redistribution to help the poorest to cope with risk. Warehouse receipt systems are systems which allow farmers, producers, to deposit a quantity of a certain food commodity into an approved warehouse, and in exchange to receive a receipt from that warehouse. And that receipt is a formal financial instrument that allows them to access credit, to use the receipt as collateral against a loan. And it also allows producers the flexibility to sell throughout the year. Rather than selling all of their produce when they first harvest it, they have the possibility of storing it in a warehouse and releasing it onto the market at a time when prices might be more advantageous to them. And this is a system that works very well in more developed countries. South Africa has a very sophisticated warehouse receipt system. But where it's been tried in less developed countries, we haven't seen it operating so successfully. And the difficulty, I think, is that you need to have very well-established quality control procedures for it to work. You need to have rules and regulations and supervision. And I think most importantly of all, you need to have consistent government policy, because producers aren't interested in saving, in storing grains if the government might intervene at any point to undermine their investment in those grains. Well, the concept of weather insurance is actually quite simple, because what it's about is insuring whole groups of producers under a single blanket policy And the policy kicks in when certain easily observable characteristics, like rainfall, pass a certain trigger point or fail to pass that trigger point. So what we can see, and there are examples of this, both at a pilot level and in India at an operational level, systems where insurance is provided against the risk of drought, of insufficient rainfall. And what happens in this case is that against the premium to be a part of the scheme, the producer benefits if rainfall falls below a certain point. And in some cases there's more than one point and more than one payment amount. So if payment falls below a certain amount, that triggers an automatic payment by the insurer to the producer. And that can happen very quickly, very efficiently, and it's a way of providing insurance to small-scale farmers who wouldn't be able to access it through normal commercial farming insurance mechanisms. Social transfers are probably the most formal of these mechanisms to help the poor to manage their risks. By providing them with a regular social transfer, they have the confidence to engage in more risk-taking than they would otherwise do. They have less problems of seasonality. They are given benefits that they will invest some of the money in education, health, and so on. So it has intergenerational benefits as well. But the most important thing is that it allows individuals to manage risk much more effectively. And I think we've seen a number of different types of social assistance programs in very many different countries. Some are successful, some are not successful. And I think one of the keys to success is becoming increasingly clear that what really matters is government ownership of these social assistance programs. We've seen examples like Lesotho, for example, where they've gone ahead with the introduction of a universal social pension against the advice of all the development partners who felt that this was unaffordable and unsustainable. But it has in fact, it has become a feature of the political landscape. It is very sustainable. It's gone on. The value of the pension has increased after each election. And we've seen a program that is owned now by that government. Set against that, we've seen a number of examples where donors have come in with sometimes contradictory suggestions of how a government should be doing social assistance. And those tend not to have found any political favor. They remain as pilots. They don't get scaled up. And a good example of all this is Malawi, where the government has made it absolutely clear over the last 5 years that its priority for providing protection to its poor rural farmers is through a fertilizer subsidy program, which has been running very successfully for 5 years, and which again, initially the donors resisted because they don't favor subsidy programs. But the program has been very successful. At the same time as that's been happening, different donors have been pushing alternative approaches to social protection. So we've seen UNICEF engaging in a social cash transfer pilot to the poorest 10% of the population. We've seen DFID trying to support the idea of a social pension for everyone over 65. And we've seen the World Bank continuing with a model of social action funds, community works, public works type programs. And I think that what the donors should have done was to have started with the government program, to have started with a program that has political momentum, and to have said to the government of Malawi, look, we can make this better. We can help you to improve this program so that it meets our objectives as well as yours. You must be aware that there are a number of people who don't have land, who don't have labor, who are falling outside of the benefits of this program. How do we find a way to help you to reach those people? You must also be aware that a number of the smaller farmers in this program, the first thing they do is to sell their fertilizer voucher, to raise cash. If it's cash they need, couldn't we have a subset of this program which is providing cash to the very poorest among those farmers, that's helping them to meet their cash needs rather than their fertilizer needs in the first instance? What happens to you as a government when we have the next major drought in Malawi, all of this money that's gone into the fertilizer subsidy program will effectively be wasted. How can we ensure against that? How can we set up some kind of futures option with the commodity exchange in South Africa that will guarantee you the ability to import at a certain price if the harvest fails and you don't get the benefits of your fertilizer subsidy? So I think a key lesson around social assistance is this question of national ownership of the programs and of donors coming in behind that, working around the edges, working with the governments to make sure that those programs are as efficient and as effective in reaching the poor as possible. I think the donors as a whole are recognizing the benefits of this kind of risk management, and I think we are seeing a greater interest, particularly within the European Commission, at getting involved in supporting this kind of program. And in each of the three areas that I've mentioned to you, there are examples where the Commission is getting involved, is supporting programs, and I think that's a very encouraging sign. But to me, it is very crucial that this should be done in a way that minimizes policy intrusion, but which maximizes technical support.